Thanks for joining us at Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
I'm Meera Dugal. Let's get you the headlines. The Nifty and the Sensex hold on to morning gains. The entertainment shares lead the charge.
HDFC Asset Management will purchase SL Group's non-convertible debentures worth 500 crore. This will transfer any loss made by its fixed maturity plan investors to itself.
Lenders to Jet Airways will approach the NCLT to initiate insolvency proceedings against the crisis-hit airline. The stock slumps 30%.
IndiGo orders 280 engines from a joint venture of General Electric and Safran for $20 billion. The carrier is looking to replace Pratt & Whitney engines that power Airbus Neo aircraft.
Right, let's first take a look at how markets are faring. Yatin Mota is here with us. Afternoon, Yatin.
Afternoon, and 2 days of cut in this week, and finally we are looking at some bounce back which has happened on the markets. We have recovered almost 100 points from the day's low as far as Nifty 50 is concerned. Almost 0.5% up on the key indices at this point in time. The Nifty 50 advanced decline ratio also is slightly healthy at this point in time, recovering from the day's low. Right now, the advanced decline ratio is 3:2. As far as gainers are concerned, of course, as you mentioned, Z, that stock is up 3% in trade. However, we have the private sector banks as well as some large cap PSU banks which are doing well. So we have IndusInd Bank, ICICI Bank, and SBI, all of them gaining anywhere between 2.5% to 1.5%. Also, selective counters like Vedanta and BPCL are doing well. What's not doing well is the entire NBFC space. So we have Indiabulls Housing Finance, Reliance Capital, Diwan Housing, all of these stocks correcting anywhere between 4 to 6%. So the pressure really continues as far as that segment is concerned. In the Nifty, we have Asian Paints, Britannia, as well as Infratel. These stocks, the key losers in trade. As far as active securities are concerned, we have Jet Airways. That stock has slumped nearly 30% as we had the 10% circuit limit that got just revised to 25 and now 30. If you look at the futures also, they are trading at a 30 rupee discount to the spot prices. So clearly, there has been a lot of pain as far as Jet Airways is concerned for trade today.
Interesting that. In a move to rescue investors of a fixed maturity plan, HDFC Mutual Fund will buy non-convertible debentures of SL Group companies worth 500 crore. This would transfer any loss due to the investments from investors to itself. Darshan is standing by with some details on what HDFC has done.
Yeah, so Harsha is not going well for HDFC Mutual Fund because the stock is down almost 5%. So the bailout was first close to 500 crores and they've already lost 2,500 crores as far as market cap is concerned because of this. Now, the logic is that two schemes there will be liquidity infused or this buyout will happen. First of all, the first scheme is that if the scheme have already been matured in April 2019, or secondly, the scheme will apply to those for the schemes in which the deal between HDFC AMC and SL Group is already there. Only a couple of brokerages have come out. Morgan Stanley, for one, does believe that this should benefit investors and improve sentiment only for the unit holders. But the move will transfer risk of under recovery to the company, and that is why the stock is down almost 5%. They are saying that this entails HDFC AMC is assuming a financial risk in the event of any kind of under recovery, and the security cover now moves down to 1.2 to 1.5 times. Versus the earlier 1.4 to 1.8 times. So obviously the market not liking that unit holders are preferred over the shareholders of the company, which will probably have to take this hit. In case everything goes, they will have to take that hit of 500 crores. No one knows what will happen, but the market doesn't seem to like it.
All right, thanks so much for that, Darshan. I think there are a whole bunch of questions that are being raised around this move, and we'll put them across to Dhirendra Kumar in just a minute. But some of the issues, Harsha, is this a loss that the shareholders need to bear? It's sort of a socialization of losses, right? I mean, at the end of the day, people who were invested in that one FMP should have taken the hit, but now you're socializing the losses. But on the flip side, the question is that the fund is not making good on the promise that they will return that money at a fixed date. So then maybe they should take a hit, and also it was their decision to do that standstill, etc. So I think there are a whole bunch of questions. Also, if you do this once, who makes the decision on for which paper you do it and for which paper you don't do it?
Correct, that's the question, right? The message that this sends out is why is that these bunch of investors are protected from any form of market risk.
Yeah.
And this was a classic market risk. Now you can go back and question why they went into the standstill agreement in the first place.
Yeah. Yeah, no, absolutely. I mean, there are a whole bunch of, sort of corporate credit issues right now that debt funds are facing, right? So do you bail out one set of investors, who have exposure to, say, the SL Group paper? Do you do it for everybody? Should there be some benchmarks in place? We are told that this has been done in the past, so I think Fidelity had done it in the past, but that doesn't mean that it's the right way to approach it. I think Dhirendra Kumar, CEO at Value Research, is with us now, so he should be able to help us answer some of these questions. Dhirendra, thanks so much for taking the time to speak to us. Bunch of divided views on this move, so let me first ask you for what you see this as.
No, this is a fairly straightforward thing. It's a wrong thing because principally because mutual fund is a pass-through, and you are setting a wrong precedence, and it will create quite an unequal marketplace. But the other side of the story is that the regulations, or the fixed income industry, it has become pretty large. There is a very serious disconnect between what investors get and what is the underlying. The underlying market is not very liquid. Investors get almost instant liquidity. So in that sense, it's a very unreal market. You need to make exceptions, and there are some questions which will never get answered. That what if this liability was turning out to be, if we are faced with a similar situation, which will translate into a potential liability or a contingent liability of 10,000 crore or 20,000 crore. No net worth will be good enough. Mutual funds are not banks. So that's one side of the story. The other side is that what was permitted, what has been done, fixed maturity plans. What do you do with a situation where a part of the investment is stuck? I think SEBI enabled the segregated portfolio mechanism, what is popularly called as side pocketing. Why it could not be done, or why the scheme was extended. So we have to see that what is the regulatory view on this. And then the third part of the story is that what happens to HDFC Asset Management Company shareholder. I think there's good news and bad news for them. This creates a different kind of traction around HDFC Asset Management Company's products. Also, it will be trusted more. But is this the right way of enhancing trust or building trust? There are principal questions which will remain unanswered.
That's the principle is what I want to ask you about as well, Dhirendra. Why only this FMP? I mean, what is it? Mutual funds have been, shouting from every rooftop saying mutual funds are subject to market risk. This was a market risk. Why should only these bunch of investors be protected?
Yes. Yes, this is a market risk, and you are faced with the risk. And there was no need to protect it, because if the eventual realization, whether you get 70 rupee of your 100 or as and when it's resolved, or the deferment or the delay, but I don't know what is the regulatory framework under which the ANC could have done. They extended the scheme. They in their wisdom have decided to provide this what they are calling is liquidity mechanism. But yes, this is the breach of the key principle of mutuality.
Dhirendra, I mean, just to put a counter argument, although to be honest, it doesn't make much sense, that the fund house had decided to agree to this standstill. So in some ways, the fund house put the investors at risk. They could have generated some liquidity by selling the stocks which were backing these debt instruments. Is there any rationale along those lines that perhaps then the fund house has to bear some of the risk that has been passed on to investors?
Yeah, I think that would have been the primary reason why they would have taken a view around this, and that is what is stated in the press release, that they have it is based on that. But this actually but the one is the letter part of it, the other is the spirit of it. The spirit could be quite damning in a sense that people will tend to expect that mutual funds will eventually bail out or bridge the shortfall of any substantial such situation arising. There will also be a discrimination in the marketplace. People will evaluate AMCs based on, so far in our own evaluation, we never thought of AMCs which are better capitalized or, not so well capitalized, or their antecedents because they are very, tightly regulated by the regulators, and they have to, and everybody has to comply with the same rules and regulations and framework, which is good enough. Now, this another dimension comes into play that, just in case something goes wrong, who can actually write the check?
Right. Dhirendra, so just a last question, again, coming back to the regulation part. I mean, obviously the side pocketing, as it's been called, has been permitted. Are enough people using it, being able to explain it to the investors? Do you think from the regulatory side there are no options that are needed to deal with contingency situations such as this?
No, this is not a contingency situation. When you put your money in stocks, stock market goes down and goes up as well. When you buy bonds, sometimes the bonds don't translate into timely repayment of your interest as well as principal, and sometimes they go under. So I don't think this is a very unusual thing. It has been provided in the law. What we have to really understand is the peripheral things. There are things about things which are still unclear, that are fund companies supposed to take collateral, which happens to be equity. I think these are regulatory, the exposure to structured obligations, which get structured as a fixed income. And how much exposure should they have? That exposure, should they have that exposure to those complex fixed income securities, which is created out of complicated structure? What kind of, there are situations where it is not an investment class security, but because of some external some kind of guarantee or some kind of additional collateral, it becomes worthwhile. Should fund companies be, or should funds be allowed to invest in those? Those are things on which this situation is prompting us to, prompting a context whereby we need greater clarification on their operating framework.
Dhiren, we'll leave it there. Many thanks indeed for joining us. Dhirendra Kumar from Value Research, talking about HDFC AMC and its actions. Yes Bank, meanwhile, plans to raise about $1.2 billion over the next 1.5 years to boost its capital buffer. The fundraising will be through a mix of public and private share sale. Rahul Satija of Bloomberg News now joins us with more details on this one. Rahul.
Yes, Harsha, you're right that Yes Bank is planning to raise about $1.2 billion. The idea is to raise capital buffers which have fallen amid a surge in bad loan provisioning. This has obviously constrained banks' ability to extend credit. So the CEO, Ravneet Gill, said that his number one priority is to raise capital. The money will be infused in 2 equal tranches, starting with the first one by the end of September. We also need to remember that Yes Bank has one of the lowest core equity capital among its top 5 peers, and about 200 billion rupees of exposure to junk-rated companies. So this would be very handy, when the money will be very handy.
Rahul, thank you so much for that.
And we spoke earlier to Suresh Ganpati, head of financial sector research at Macquarie, about Yes Bank, ICICI Bank, and the NBFC sector. You can catch that conversation at 1:30 today. Lenders are going to take Jet Airways to the National Company Law Tribunal. The creditors who met on Monday took the decision after Etihad and Hinduja Group put down some tough conditions which were not acceptable to lenders. Vishnath Nair wraps up all the action which eventually got Jet Airways into bankruptcy.
So 6 months since the process for resolving the Jet Airways crisis started, lenders have finally decided that they're going to approach the insolvency and bankruptcy court for a resolution of the case. Now, what we understand from our sources as well as a statement by the lenders is that State Bank of India will be approaching the NCLT for an insolvency proceeding against the airline. There was a statement, as I mentioned earlier, by the Jet Airways lenders where they had mentioned that they had met earlier on Monday where they saw that the only bid that they received, which was from Etihad as well as Hinduja, was a conditional bid, as well as the requirement of investors as well as any kind of exemptions from the market regulator SEBI would be better met under IBC. So these are the reasons why SBI as well as the rest of the lenders decided to go ahead with an insolvency proceeding. They're saying that they have been working tirelessly HDFC to resolve Jet Airways outside IBC, but in view of the above, the lenders have decided to seek a resolution within the confines of that specific law. Now, what was this bid that caused them to go for the IBC route? Let's try and understand what Etihad as well as Hinduja Group had proposed as part of their offer for Jet Airways. As part of the offer, what we understand from our sources is that the financial creditors or the lenders to the airline would take about a 95% haircut on their 10,000 crore plus exposure to the airline. The operational creditors, which includes lessors as well as the employees of the airline, would end up taking about a 69% haircut. What we understand is that their dues were about $1.3 billion, against which the bidders are willing to offer only $400 million as a settlement offer. But an important condition that the bidders had put forth was that the financial creditors will be the ones who will be negotiating with the operational creditors and try to get them in on this deal. And unless the operational creditors actually sign up for this deal, Etihad and Hinduja will not go forward. So there were these two sore points. The first was on 95% haircut, as well as the second one on the lenders actually negotiating with the operational creditors. These were the two sore points why the Etihad-Hinduja deal did not go through. Also part of the plan was about a $700 million equity infusion that was proposed by Etihad and Hinduja into Jet Airways so that the airline can be revived again. Remember that Jet Airways has been grounded since April 2019. It has lost many of its slots at various airports. Many of its planes have also actually been repossessed by lessors, as well as the airline senior management has already left, has already resigned and left. And therefore, the airline is currently in a very critical position. And unless this money comes in and a new management comes into the airline, it cannot get back up flying. And that is why the lenders have decided to go for the IBC treatment for Jet Airways, hoping that they will find that new bidder they're looking for.
Thanks, Tushar, for that. IndiGo is finding a fix for its Pratt & Whitney engine troubles. The budget carrier has placed an order for 280 engines from a joint venture between General Electric and Safran. The new engines will power Airbus new planes that IndiGo has ordered. Bloomberg News PR Sanjay now joins us with more details on this deal and what this really means for IndiGo.
Paris Air Show is always interesting.
Are you going?
No, not really. I would like to. So it's always it comes up with the new surprises. So in this one, this latest one is by IndiGo, which is the largest airline by passengers carried, which has opted for a GE Safran, CFM engines. IndiGo was undergoing a lot of troubles because they have opted for Pratt & Whitney, which has grounded world's most cheapest narrow-body plane, which is A320 Neo. So there's two ways to look at it. So one set of experts are saying that this is nothing to do with the troubles, because any engine will take its own time to streamline things, but it has taken more than expected time. So it will come back. That's one way to look at it. And the second thing they're saying that as an engine manufacturer, they would have offered better deals for IndiGo that would have fetched the deal. IndiGo is now playing with the size. So an airline which once it completes 25 planes of size, it is a different airline. Now it has got over 200 planes, and it can actually demand, it can insist terms, it can dictate terms with engine manufacturers. But for time being, they are now done with Pratt & Whitney troubles. They would be going with GE Safran, which is expected to overcome all the troubles which is associated with Neos, and they will save some money in terms of fuel expenditure.
Sanjay, thanks so much for that. Hindustan Unilever depends on a handful of brands to bring in lion's share of its revenue. The country's largest FMCG player has launched a lot of products across categories, from beauty and personal care to food and beverages. But it's mostly the older brands that have delivered steady returns. Charlene D'Souza has gone through the annual reports to collate just how much these brands actually contribute to HUL's top line. Let's go across to her.
While food and refreshment brands are picking up momentum, it's the core brands in HUL's beauty and personal care portfolio that are major revenue drivers. In FY19, Fair & Lovely and Lifebuoy were the highest contributors in terms of revenue and feature in the Rs 2,000 crore plus brand club. Other brands like Dove, Lakme Lux, Clinic Plus and Pond's are in the 1,000 crore club, while Pears, Vaseline, Sunsilk and Close-Up are in the Rs 500 crore basket. However, in FY13, none of the personal care brands were in the 2,000 crore basket. Fair and Lovely, Lifebuoy and Lux were all part of the 1,000 crore club, while Dove, Pond's, Clinic Plus, Close Up and Pears saw its revenues at rupees 500 crores. While HUL did not provide data for FY14, we have considered the brands to have held the same position as FY13. However, in FY15, Lifebuoy saw its revenues at rupees 2,000 crores, while the rest of the brands did not change. In FY16, Fair and Lovely also moved into the rupees 2,000 crore club, while Dove, Clinic Plus and Pond saw its revenues move to rupees 1,000 crores. In FY17, brands stayed where they were, and in FY18, Sunsilk made its debut in the 500 crore basket and Lakme entered the rupees 1,000 crore club. Beauty and personal care's contribution to HUL's revenue has been over 45% since FY16. However, its contribution has declined by 130 basis points over the last 4 years. To read on the home care and food and refreshment brands, do log on to bloombergquin.com.
From Hindustan Unilever to ITC, that's managed to earn more than half of its revenue from non-tobacco business for the first time ever. Agam's here to take us through the details. Agam, it's been quite a feat for ITC.
It certainly has, Harsha, and that's not the only positive takeaway from this year's numbers as far as ITCs goes. So let's talk about one of the first few aspects that I did want to address. Of course, while we have seen your revenues from a non-cigarettes business move by well over half the consolidated revenues. The other positive here is that after 5 straight years, we've actually seen a little bit of an improvement when it comes to its return ratios, which includes return on equities as well as return on capital employed. So there is an uptick in both these numbers. This has been a very marginal one, but an uptick all the same. So we do have an improvement on return on equity as well as return on capital, and this is largely on account of the fact that the contribution to profitability from the non-cigarette business has also increased. As far as your free cash flows are concerned, there has been a little bit of a problem here, considering there has been a stressed working capital conditions. We've seen that, and this is largely on account of rise in receivable days, and which is why there has been higher capital expenditure, and hence we have seen a drop of as much as 7% in the operational cash flows. On the other hand, it was the cigarette business. While we did see a decline in volumes in the previous year, this year has seen an increase of around 6%, largely on account of the fact that there really wasn't too much change in terms of taxation on cigarettes, and of course new variants aided growth. We also saw segment margins dip only marginally. Coming down to your FMCG is excluding cigarettes business, we saw the segment rise around nearly 18%. Brand drivers Yippee and Ashirwad Atta essentially were the ones which actually drove growth. Moving on, we're also keeping an eye on scaling up in juices, chocolates, as well as coffee and dairy products as far as ITC is concerned. So it is expanding into other markets. But as far as your other factors are concerned, we can keep an eye on hotels business, which actually did very well this time around on the increased occupancy rates, as well as paper business, which also improved on account of end user segments. And of course, finally, while the agricultural output did increase, exports were not up to the mark, and that was an overhang that did play out against ITC. But on the whole, it's had a reasonably good year. And of course, for starts, we've also seen improvement in return ratios, and that is what investors will take away as a positive from ITC's annual report.
Thanks so much for that, Agam. Automakers in India have been facing a sharp slowdown in demand since December, and they've been unable to attract customers despite discounts. But when you break down the data regionally, which states have seen the worst hit? Yash Upadhyay has gone through the data released by the Federation of Automobile Dealers Association to find that out. Yash.
So the overall auto vehicle registrations for the month of May, they were down by around 7 to 8% on a year-on-year basis. That number stood at around 17.71 lakh units for the month of May, as compared to a number in excess of 19 lakh units, which was sold in the retail market in the May of last year, which is a 7.5% drop. However, on a month-on-month basis, there has been a slight improvement in sales. But moving on to the individual states, 22 out of the 30 states states and union territories for which the data has been released by FADA, they have reported a negative growth in the vehicle registrations, and the data would have been much worse or better based on whatever happened in the top 5 markets, because the top 5 markets of Uttar Pradesh, Maharashtra, Tamil Nadu, Karnataka and Bihar all have reported a degrowth in vehicle registrations on a year-on-year basis. Uttar Pradesh, which is the largest market for all vehicle registrations, that was down by almost 20%, followed by Maharashtra and Tamil Nadu down anywhere between 7.5% to 12%, followed by Karnataka and Bihar, which were also down close to 5% each. On the other hand, there were only about 8 states which reported an increase in vehicle registrations, and a majority of them, or in fact 5 of these 8 states, belong from the northeast region: Arunachal Pradesh, Mizoram, Assam, Sikkim and Manipur. They were the ones that stand out. Arunachal Pradesh had the highest growth in vehicle registrations, in excess of 31% on a year-on-year basis. But let's also take a look at what has been the trend as far as the individual states are concerned, and only 3 states reported a growth in vehicle registrations across all categories. By all categories, I mean the 2-wheeler, 3-wheeler, passenger vehicle and commercial vehicle, and they include the likes of Jammu and Kashmir, Chhattisgarh and Rajasthan. On the other hand, weakness continues to remain as far as demand goes in Odisha, Jharkhand and West Bengal. But key to highlight here is West Bengal, because it's the only state which has reported a degrowth in vehicle registrations, both on a year-on-year basis as well as on a month-on-month basis. So across the categories, there has been a significant drawdown. 2-wheeler sales were down by about 28.5%. Similarly for commercial vehicles and passenger vehicles. So combined on a year-on-year basis, their sales were down 26.5%, and on a month-on-month basis down by almost 8.5%.
How do you think these categories have done for rest of the states?
So taking a look at the individual category, Harsha, the total 2-wheeler sales, those were down by about 8.6% on a year-on-year basis, and this was particularly down to the fact that the sales continued to remain weak in the 3 top states, which are the likes of Uttar Pradesh, Tamil Nadu as well as Maharashtra, all of whom have seen a big drop as far as vehicle registrations are concerned on a year-on-year basis. However, on a month-on-month basis, due to buying on account of the marriage season as well as slight improvement in terms of the liquidity with NBFCs, has aided the volumes as far as 2-wheelers are concerned. However, passenger vehicles, they fared better than the 2-wheeler space, only about a 1% drop in the year-on-year sales, and this was mainly on account of a 6% growth that Maharashtra saw, which was the only state among not just the top 3 but also the top 5 states to have reported a growth in vehicle registrations. But moving on to commercial vehicle space, and there was a diverging trend that we saw there. The top 3 states in terms of vehicle registrations, that reported a strong double-digit growth on a year-on-year basis. However, it was the slowdown in demand in the other key states which impacted the vehicle registrations and bringing down that number. Bihar sold 3,500 fewer commercial vehicles this time around, which indicates a 42% drop, along with Jharkhand, West Bengal seeing drops of anywhere between 44 and 26%. Uttar Pradesh not too far behind, a 34% fall in vehicle registrations there as well.
Yash, thank you for that. Out of time on the show. Thank you so much for watching us today.
Thanks for watching.
How many places